Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, March 26, 2024. It is 12:57 p.m. Eastern Time. I'm starting the video, so we've got about 3 hours left in the trading day. And what I'll do in this one is a relatively brief overview of the equity markets. We'll look at the major indexes, QQQ, SPY, IWM. I'll give you some fun facts on the group that I formerly referred to now, or my name is the formerly known as Mag 7 group, and then just kind of trade ideas where the opportunities I believe are right now, and that's just we're going to look at a couple commodities. Had a question about wheat yesterday. Very glad somebody asked me about that. That looks like it's setting up pretty nice. I'll do an update on DBC, the broad-based commodities ETF, and then cocoa. If you've been following, cocoa's gone to the moon. Looks like Bitcoin on steroids. So I just took a starter short on that today. And then time permitting, I'll get to Bitcoin. I don't have strong convictions on it, but every now and then I get some questions put to me. So let's start here with this 15-minute chart. Kind of been living in this shorter term time frame lately. Gave you a most recent setup yesterday here at the downtrend line for an active trader. And then on Thursday, both active trader and swing trade. And remember, initially posted the chart of the futures. That's typically what I trade NQ, and then I say watch them both. So right there, that's when the, what was it, second target? I did an update yesterday. We hit on NQ just above the gap on QQQ, bounce. This was a downtrend line yesterday. We've taken it out, but we've also reversed shy of that previous reaction high. So basically that downtrend, and it wasn't really well defined either. You had a couple reactions on it, and three, it's minimal. In my book, it takes at least 3 reactions to validate a trend line. Anything else, 2 points can be connected at random. That's why I say that. And now, so we have a potential new downtrend line right here. And, we are in a, what they call, or what I call, a very near-term or short-term downtrend. That's the in market making lower lows and lower highs so far since that post-Fed pop. Like I said, as long as, sometimes downtrends aren't so perfectly clean with the reaction highs and lows, but as of now, that's what you have, another reaction. Lower lows so far, 1, 2, 3 that I just circled, and I'm sorry, lower highs that is, and then there's lower lows. So what you need to do to build on this, and sooner or later, any short-term trend, bullish or bearish, has the potential to morph into an intermediate and then ultimately a longer-term trend. So right now, again, the 2 trades laid out last Thursday at the top of the range was both a swing trade, and I said for swing traders, ideally they can have zigs and zags along the way. Target a move down to at least the bottom of the range, but then I also shared my thoughts. I think if we get that, I have a high degree of confidence we'll break the range. It'll be a big deal because, number one, why do I think that? Well, first of all, it's getting long in the tooth. The technicals, nothing's changed there. I said pre-Fed, and I've been saying this for the last couple of weeks, should the markets go on to make any new marginal high anytime soon, it's not going to change my outlook or because it won't change the technicals. So again, I'm talking daily chart. I'm talking daily and weekly. Divergences have been building and aren't even close to being taken out. And on the contrary, the slope of the divergence, in other words, the momentum is stalling out. Remember, when you go up, momentum, when something's going up, if it starts going sideways, the momentum has stopped. It's like throwing a rock into the air. If you kind of super slow-mo, there's that brief moment in time where the rock's just sitting there, not going up anymore, not going down, and then the turn comes. And, sometimes that's just a consolidation and an uptrend, but that's what it is right now. So as I've been kind of focused on, that's this box right here. This purple box just shows the consolidation, the NASDAQ 100 kind of stalling out recently. And if you go in your little micro world here, these are the zigs and the zags, and there's the Fed meeting. And as I said, heading into the Fed and after the Fed, it's what I call post-FOMC noise. Fed meeting was on a Wednesday afternoon. So, the first full trading day was Thursday. That's when we got that, swing in trend, active trader short entry. And so far, they've been selling off the post-FOMC pop. So this was the Wednesday afternoon rip. So why do I think that if we get down to the bottom? Because all that will be faded and then some, and I think that'll just tell us it was just that knee-jerk reaction. So look, we can go either way. We're still far from, we have not, and I'll reiterate, we have not had those kind of all in or high, what I call high probability sell signal. That is a break of 433 on QQQ, and the majority of the leading indexes in the S&P 500 and the Mag 7. But let's get to that 1 second. So there you are. There's the new downtrend line. And when you go out to the daily chart, which I'm doing here, you have basically, virtually an equal high right there. I think it's ever so slightly a marginal new high. And here's what's interesting. So this is the fun fact I was going to share. The high back then on March 8th pre-Fed was 448.64. You can see it in the upper part of that pop-up box to the left. And then this high the other day, intraday, was 449.34. So you had, and they were cheering it on CNBC, new highs in the indexes. Guess what? Taking a look at the chart of, again, what I call the formerly known as Mag 7, and guess how many stocks have post-Fed made a new high, a new all-time high, like the indexes? One stock, Microsoft. All these others, Apple, we know, is just well off its highs. Apple's no longer, in that group. So it shrunk to the Mag 6. Obviously, Tesla first, so it shrunk to the Mag 5. Is it... hold on 1 second. I thought Amazon might have punched through that. Let me make sure. I'm going to show you real quick. I might have missed a little check mark there or not. Let me see. Amazon, let's go to them. Microsoft, yes, because there's that high right there, and if you zoom back, that's an all-time high post-Fed. No, I think I'm right. It was, and it was, by the way, it was a, yeah, that's right. I'm correct. There's Amazon. Amazon peaked back in 2021 and still below those highs, well below those all-time highs. So I was correct. And that high on Microsoft, by the way, was a less than 1% above the previous high. Look, not a big deal because you can spin it the other way and it shows broad-based, the rest of the, the lower tier stuff. I just see a lot of short covering. Those are all up. Again, do what you want with that fun fact and, don't read too much into it. But I thought it was interesting, again, out of those formerly known as, at least in my opinion, Mag 7. Only one post since the Fed meeting has made a new all-time high. Okay, so let's go to SPY. We have that benefit of the doubt trend line I gave you leading up into the meeting. There's a trend line. We had this yellow trend line, but again, we had so much noise around and leading into the FOMC meeting. It's what I call pre and post FOMC noise, which gets shaken out this week. So far, they faded a lot of, but not all of the FOMC rally. If you want to look at it this way, you go to a 5-minute chart. That's what you can do. This is a 1-minute chart. Go down here to a 5-minute chart. I told you yesterday, and this is when I gave you the post right here, we had faded exactly half. This is the S&P 500. So there's the 2 p.m. mark. That's the... let me make sure I had it on there correctly. Yeah, that's it. Right there. There's where we ripped at 2 p.m., went up, and we faded half of it so far. That's 50%. You put up Fibonacci's from the low to high. And so, again, roughly half right there. And in QQQ, let's just see for kicks and giggles, FOMC right there. I don't have the fibs up, but I can certainly add them real quick. Down to that's when you can see the algo started taking off, so we've retraced. Let's do it this way. Put that fib up there, and we came down and retraced 61.8, so that's the 61.8 fib right there. So far we've retraced about 2/3, nearly 2/3 of the post-FOMC rip. Now, look, we're above it. There's the FOMC day. There's the gap the next day, Thursday, where we shorted. So we're, it's not victory by any means for the short trades. But the takeaway, again, this is where I see the opportunities. If you're a swing trader right now, and you only trade the indexes, which I'm going to speak on that again. I try to often talk on that because it seems that's where I get 90% plus of the comments, and it is where I do a lot of my analysis to kind of equity markets. But I always extol or preach the virtues of trading diversified, whether you're a swing trader, trend trader, even an active trader, spread out, especially swing trading investing where you have positions that you're keeping on for a while. Then you want to definitely trade not just different stocks, different sectors, but different asset classes. Stocks are one asset class, bonds are another, commodities are yet another. Crypto is kind of maybe its own thing if you want to call it an asset class. And but this is what I was trying to say. We've gone nowhere. We are towards the higher end of the range, but again, it's a trading range now that's gone on for pretty much since mid-February. Now let's talk on that real quick and jump over. I'm just going to no, I'll get to that next because I want to talk on commodities, but let's just keep it on the equity markets. So that's that. I still think we'll work our way down quite likely to the end of the zone for swing traders, active traders. Like I said, 5-minute chart's a good guide. Look for divergent lows, divergent highs, 15-minute chart. But let me give you the small caps as well, and talk about Treasury bonds and interest rates and the Fed and all that good stuff. So here's IWM. Most important thing I see, when you look at a weekly chart, you had this trading range back here when the small caps peaked back in 2021. They had the false breakout and divergent high, failed breakout of that trading range. Again, I should use my box tool. I'm using a circle tool, but you can see I already have it colored up with a box. Tool color, this color stands out. This is the trading range I'm talking about. It was about a year-long trading range, and then we broke below it right there. And so that's what we've come up and tested now. So we have trading range here with the top, the false breakout, broke down below it, back tested. And then that's so far where we've stalled out at. And so it's given us this much larger trading range here, which we're at the top of. And if you look closely, you can see the PPO is poised. It hasn't yet done so, but it's poised to make a bearish PPO crossover if we get rejected here. And then to drill down a little smaller time frame, remember, this is a weekly chart, big picture. When you go to the daily chart, this is most important. So here's that, again, that or bull market high trading range right there. This is the current trading range we're in right now. And then if you zoom in real tight, the most important levels to me are the uptrend line off the lows from the bottom of that trading range. We had negative divergence. 208.50 was the bottom of that 2021 trading range. Breakdown pre-Fed back test. So far we're below it. So that is just TA 101. You have a uptrend line, bearish rising wedge on the daily here. Breakdown with a big impulsive red candle on the breakdown back test, and so far we're below it. So you can make a case to continue to short IWM as long as you remain below that 2021 trading range. Ideal on a weekly closing basis, in my opinion. And this goes to QQQ and everything else. IEF ideally remains in the yellow zone for weeks, actually months now. I've been highlighting and put this chart out here. And in the yellow zone, you can, if you're so inclined, that's where you can short rallies into resistance like we did on Thursday. Or, if you're a bull, you want to see the market get back in the green zone. And if you're a bear, then if you're back in the green zone, you might second guess, or especially as a swing trader, maybe hold off shorting rallies into resistance because that should be net bullish for stocks. And again, should be, and I use the word net bullish, not guaranteed bullish. I have to be very careful with my words. Why? Because there is a possibility here that if and when we break those, especially if we take out the key support levels, the yellow support levels I'm watching on QQQ and SPY in the market leading stocks, many of which have already broke there, some of which I should say, but the sectors. So we break down there. You could get a flight to safety, institutions buying treasury bonds, selling stocks. And that would be one case where bonds are going up, meaning interest rates are falling. That's not net. That's not actually bullish for the stock market. It's more of a result of the stock market falling. So again, that's a little asterisk caveat that I put in there. And it's important to note. But just to kind of analyze treasuries, because they are, in my opinion, very, very important, especially this 10-year. There's the downtrend line right there. Again, this is our yellow zone right here. We remain in the yellow zone. We hit, last update I gave you was right here. I told you we're coming up on support at 94.10. Probably get a reaction there. That was a gap right there. And it's not just a gap. That is a significant support level. But you have another gap right there. It's the bottom of that gap. You have reactions from above there, reactions from below there, gapped up there, reactions. So it's a pretty decent support level. I expected at least a reaction. That's what we got so far. So that's it. So let's not beat a dead horse. We remain in the yellow zone. You know what that means. Stocks start to take note of rising yields. And so I think that holds true. Since we've entered that, remember I just showed you a minute ago, QQQ has been moving nowhere but sideways now. The market leading, the highest, the growth index, the one that usually leads the market, has been treading water now since February. So for over a month, and that's not mere coincidence that's when we entered my yellow zone, which I laid out in advance. So yes, the market has taken note of rising yields. Orange zone is where I believe if we get there, it'll really start to take note, meaning instead of going sideways, your then market will be going down. In this, I have really no, like I said, no asterisk or anything. I think if that happens, I have a high degree of confidence that the stock market will really start to take note of rising yields, and then red zone, the market will freak out. So again, more of a prediction of what will happen if we get there, not as so much are we going to get there. And I put decent odds on it too, based on the technicals out there and everything I'm seeing. And I guess this kind of segues into, now that I've covered most everything, the only other thing I'm going to loop back to before I move on to commodities is this board here. I have I've used in the past, met for years now, even if not decades, something I came up with a while back called a low volume sell indicator, or a low volume trend indicator. It's a sell signal really. And over time, if you followed me for a while, I've changed these lines. Where that level is completely dependent of market conditions at the time. So let's talk when the market peaked back in, it was the S&P that peaked right in the beginning of the year in 2022. We had what some call a bear market. I still consider the first wave down in one. But either way, that's that drop in 2022, the bottom in October there. And that's when, over times as market conditions shift, these low volume sell signals tend to shift. And so you can see the little purple line. So when you cross that purple line, it's the number, it's almost irrelevant. What I do, I put up a 10-day exponential moving average on the volume. The purple line's at, 65,233,270 shares. I set the line at where I see the low end of the range, and without fail, these circles here are when you hit that. And so all the biggest drops, let me grab my arrow tool, since really that time frame has started, which is, again, I think a significant time frame, the beginning of 2022, that's when all the big legs down came. We had a counter trend rally there, hit the low volume indicator again, drop there. This one did not pan out, so nothing's 100% effective. This one didn't pan out, but we're there now again. We'll see. Now, if it doesn't pan out again, then the line's going to have to get changed. It'll just mean it's no longer working. So this isn't a super high probability. And look, we did go a little bit sideways there, but not much. I just wanted to point it out that volume has been dropping off. I'm not putting a very high weighting. And again, nothing to me carries much weight right now for a swing or trend short until we take out the yellow levels anyways. Just want to say that SPY has dropped down to that level. QQQ has gotten down also. It's gotten down to also, but QQQ has been trading on or around that extreme low level. And what it also says is fewer and fewer people are buying stocks right now. So the market's not going down, but it's also not going up anymore, especially the tech-heavy NASDAQ 100. All right, let's get away from that, and now let's talk about where the opportunities are. Because again, bull or bear, swinging long or short, you're not making money, especially in the high growth stocks, the Mag 7 tech sector. DBC, this is really, as I've said recently, I threw it out as a trade idea. And one of my favorites were, as far as investment accounts, 401ks, IRAs, swing trading, investing, this I see it basically commodities as a whole, I see a much better risk reward ratio. I like them a lot more, and we're actually keeping on par, if not outperforming the stock market since I highlighted it. So it was right here recently. I highlighted it on this key support level, about 2177. It's a level I've had here for quite a while. It's that reaction high back there. And I've shared this many times. I take the view, it's not, this is an opinion, this is fact. Sometimes, a lot of times, charts, reading charts, technical analysis are like those Rorschach ink blot tests where it's, your perception of something might be different from someone else's. But again, a simple definition of a trend is a downtrend, a bear market, which commodities peaked back in '08, is lower lows and lower highs, and that's what we have. There's a high, high, high. We're going down, 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 and then an uptrend is when you start taking out previous highs, and this is by every metric, including, and I use DBA. Oh no, it's not DBA. I use also DJP is the one I was using for a while for just tracking purposes, but it's an ETN, so trading. It's almost identical to the DBC I just showed you, but you don't have to deal with the K1. And you can see, so by every metric, and I've covered this many times, you had a bear market downtrend line that was taken out. That in itself is a huge, it's an indication the downtrend's over. And then, of course, every other previous reaction high, and there's a reaction high, reaction high, reaction high. So this is, I still, and haven't waffled on this view, that this is just the initial leg up in a new bull market. A corrective phase, Fibonacci retracement levels confirm that. Everything else that's so far, only hindsight or time will tell definitively if we go on and take out that previous high, especially without falling back below those previous lows. But so again, been making the point. Now, is it running away? No. But again, it's a level where, since highlighted, we're up, off that support level. Commodities have rallied about 6%. And that's since mid-February, when again you look at QQQ, and let me just turn off all the lines here. So mid-February, QQQ has gone nowhere. So when I speak to the swing trader, the investor, the trend trader, and when I hear these comments, oh, the market's making new highs every day, guess what? Commodities are outperforming the market in the last month or plus, especially high growth tech stocks. So you can see they're virtually where they were mid-February. If you take that, that's right about when I highlighted DBC as a objective reentry for a swing or trend trade. And the NASDAQ 100, what I just did, I grabbed that peak back there in mid-February, and we're up a whopping 1.4% in the NASDAQ 100 since then. So again, it's just, where I see risk reward. And again, I say this often, commodities, they don't go to zero. You don't have financial shenanigans. Nobody cooking the books. You don't have excessive valuations. And we're still in an inflationary environment. Make no mistake about that. The rate of inflation has slowed, but we've also ratcheted up quite a bit. And again, there's just, like I said, if the technical case wasn't there, I wouldn't do it. So that's that. DBC. Again, as a commodity ETF, still looks good as a trade idea. And we've taken out the first target. Now, the first target was 2260. It was resistance and previous reaction high. We had a nice little W bottoming pattern right there. Having a hard time with my drawing tools, but there's a W pattern, and we broke out above it, and divergent low and everything else. So ideally, as long as we remain above 2260, any pullbacks to that level, and we're still consolidating above it, would provide objective entries. Next swing target 2360, 2450, and I will almost certainly, if we start to approach those targets and the charts still look constructive, I'll almost likely add additional targets. And like everything, it's not, I'll put everything into commodities. And then I also, on the same vein, I like to personally, also like to trade around within commodities, especially as a more active swing trader, and both go long the most bullish and short the most bearish. Because when you go with these broad-based commodity ETFs, both DJP that I showed you a minute ago and this one DBC, you've got the whole spectrum. You've got energy, you've got gas, crude oil, nat gas, gold, silver, sugar, all the agricultural commodities, base metals. So it's a blanket approach, easy for the one and done kind of person that doesn't have time to micromanage or really actively manage a portfolio. But here's where I'm going. Somebody yesterday asked me about wheat, WEAT. It's a wheat E10. Now, admittedly, we've had these one divergent low. Excuse me there, a divergent low, one after another, and some played out. We've also gotten in here, had some swing trades, especially on the 60-minute chart. You can see T1, 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 T1. And back here, I was saying unless we take out that T1, because that proved resistance, we were in a trading range, which we broke down below. And that was the bottom of the range here. And then boom, boom, rejected. So my reply when somebody asked me about wheat, yeah, it's starting to set up again. And so you can see that. I think it was under yesterday's or the previous day's post in the comments section there. I don't have it queued up right now, but my reply was wheat will offer an objective long entry on a break of the downtrend line and I'll define what I mean when I say and or, the R1, the first resistance level around 550. I have it at 551 right there. Okay, and or means, yeah, breakout of the trend line will be bullish, most likely bring the buyers in, but I see very good or pretty good price resistance. Again, that's that same trading range I just showed you on the 60-minute chart. And so that's significant resistance. We've already been bouncing above it. So the and or means, or says, the benefit of the doubt, give it the benefit of the doubt. Don't take a break of the trend line because you have significant resistance just above around 550. So you want to wait for that. That's the or, break of the trend line or 550. The and means you can scale in, take a breakout above the trend line, especially if we continue down, because to be very clear, and I talk about this all the time, there is a massive difference between what I refer to in this case, a short setup versus an actionable trade. It's just like the stock market with waiting for those high probability all-in sell signals. They haven't come yet. You can certainly scale in. You can do it now with wheat if you want. But the high probability buy signal is going to come on a break above that 550-ish level. A solid break, a solid daily close. The greener the better. That's basically it. You don't want to see an intraday spike and then we close down below. And if you took it, no big deal. Then just maybe don't go too heavy until you see that we're clearly taken out R1. So that's what the and or means. So and would, a little bit there and a little more on a full position on above 551, or you just play it safe because this thing's in a downtrend and you wait for a break above there. And remember too, if you have DPC or DJP as a core holding, then just know that you're overlapping. You just have to pull that up again. Go back to DBC. How much is in wheat? It already has not much, 5% weighting last time I checked on it. And so you just have to know that you're duplicating. So anyway, that's one that I think looks good as well. The other one, I told you cocoa. Unfortunately, guys, for you non-futures traders, there used to be, it's gone now. NIB was a cocoa ETN. For the best of my knowledge, when I type in cocoa, there's no cocoa ETN, ETF. Usually things that track ag commodities are using their ETNs because they're rolling futures. So it's basically there is, to the best of my knowledge, no more ETN, or it doesn't exist in ETN. So you have to trade futures. And if that's not your cup of tea, then you won't be able to capitalize on or take this trade. Okay, so by this trade, I'm talking about cocoa futures, symbol CC. This thing has gone outright parabolic. Parabolic advance, if you remember from mathematics, you have linear trend lines and then parabolic lines, which have an increasing slope. And that's what this is. I don't have a parabolic line tool on this particular charting platform, so I just have to go like this and show you, or hold on one second. I was going to queue it up on another charting platform. I just want to get through the video. Some charting platforms will allow me to draw the parabolic trend lines, but that's what that is. Nice, clean. You could draw a parabola there and get it under. And then if you zoom in, you can see we had this little uptrend line here. Now, by the way, I'm on a 6-month chart, 6 months of price history using 2-hour candles. If you want to see what the parabolic trend looks like here, I have it right here. This is stockcharts.com, and you can draw. I could put a parabola on here, a parabolic line, but you can see it clearly. I didn't have it marked up just to show you it's gone through the roof. And by the way, guys, I use log scaling, and don't underestimate when you see a parabolic advance like this on log scaling. If you turn off the log, it just blows it. It even looks way worse, the more sick. This is like, again, like Bitcoin on steroids here. You can see the price scaling, down here for years. This was the range right here where cocoa was trading. And then there's just disruptions going on in Africa right now where most cocoa comes from. And so it's gone through the roof. The same thing with orange juice futures a few months back. There was all that after Hurricane Ian and some bad weather and then some crop pests. Orange juice futures did the same thing. We got about a 36% short trade on that. But either way, you don't short a parabolic advance. You don't step in front of it. It's like stepping in front of a freight train unless you have a decent evidence to do so. Now, ultimately, usually once you see a parabolic advance, it doesn't end well, and it wouldn't surprise me ultimately to come back to the high end of that historic range right there. But this also kind of speaks to this inflationary environment we're in. With crude continuing to march back up and everything else. And that's my theme going forward. What I think is happening is that, and we've seen it, guys, for over the last year. It's amazing the market has been so accommodating with the increase in inflation expectations. Remember the whole dot plot going down. They were looking at like 6 rate cuts. They were looking at rate cuts early in the year. They were the March rate cut, and that got pushed off the table. Now we're down to 3 rate cuts. Anywho, and that's because inflation is proving sticky. We're starting to see it uptick recently. And again, this is, is cocoa going to move the needle on inflation? Not nearly as much as, housing prices and other things like that. However, it just shows you that we have this, a lot of things continue to rip. Either way, look, for me, it's a trading idea. It's a trading vehicle. So let me get back to the chart I was on a second ago, and we'll wrap up and I'll show you what I'm looking for on this one. So that is a 6-month chart with 2-hour candles. There's a bearish rising wedge, and I have my beloved divergence. That's the thing about these parabolic trends. Don't start stepping in front of them at least until you get divergence, and then ideally wait till you get a sell signal. Sell signal comes on a break of support. So on that 2-hour candle chart I just showed you, I just zoomed in now, and I'll mark it up a little bit more to my 60-minute chart. And so you can see I'm giving you levels here for this trade. There's a bearish rising wedge. There's your negative divergence, which again to me is almost a must before I even step in front of a rocket like this on the short side. That is, of course, and then the breakdown. That's everything right there. Without a breakdown, no sell signal, you don't step in front of it. So that's it. And so I took a starter position, and if this continues to build some steam, and then what'll happen when it turns, just like OJ futures, you'll start to see lock limit down, and they're not going to let you in. And that's one reason I wanted to take it today. And I'll give it room. I have a starter position. I'll either, if it just burns on through here and continues up, takes out the divergences, I'll throw it away. Or, if we get a back test, I'll give you updates on this, especially if you tell me that you're in it. Anybody else in the trade, then I'll do more frequent updates. Otherwise, I realize that a lot of folks out there don't trade futures. So, again, unfortunately, I don't believe if you find it otherwise, if there's an ETN or an ETF that you can trade that directly tracks cocoa prices, let me know. Just as I'm talking, marking up targets. I had some on that 2-hour chart. I would say, that trend line, but I think ideal. I like these horizontal levels best. I think these would be right now your 3 targets down to about 66.58. There's a preferred target, and that's it. Let's move on. Again, if there's updates requested, I will give you updates on this trade. Bitcoin, I told you I'd give you Bitcoin. Let's look at BRR. Bitcoin futures. There's some resistance we're at right now. I don't have a strong opinion. That's almost 7,200 right there. There was this big rising wedge recently, big negative divergence. We had a nice healthy correction down to support. Again, I don't have a strong read on this right now. I can say that's resistance. If you want to take a shot at it with a stop not too far above 7,200, it might plan out. You can target another move down, and especially if you can break that 61,505. But let me say this, Bitcoin, and I said this, somebody asked before the FOMC meeting last week, Bitcoin's going to move with the market. Make no mistake about it. This is the post-Fed. The market rallied. S&P went to new highs. Bitcoin didn't make a new high, but either way, it rallied. And so the fate of Bitcoin and whether it's going here or not will almost certainly, or most likely, in my opinion, depend on what the stock market does. And again, the stock market, we're just going to loop back to it. Yellow lines on QQ, 433. I have my clean board, 433. And not only did we not take it out, but that was the last time we visited. We went to the top of the range they were at, so nothing's changed. We need to take out 433. And then those top sectors of the S&P 500 as well. You have technology. I just wanted to update these. You still have that bearish engulfing candle from right there. That was March 8th. Tech is in just like QQQ. It's almost going to mirror QQQ. It never violated the top of that candle. It's still in there, but again, until 204, about 204, it's taken out. You are below the benefit of the doubt trend line. This is post-Fed, little break, a pre-Fed breakdown, a post-Fed rally rejection off the benefit of the doubt trend line. But again, it's kind of noise, and it's more the realm of the active trader until you break 204.21, then the swing trader. That'll open the door to 197-ish right there, then 193, and then this target down here in the 200-day moving averages. If we keep going up, it's more of the same. Anytime soon, we'll just simply extend the divergences. Remember, those aren't sell signals, and break above the range, solid breaks above these trading ranges. Although I will say it now, I believe they'll have a higher rate of failing. That's been the MO. Every time we make a new high, then you go back down. And the new highs are so incremental. They're, in the indexes and everything, they're fractional. They're less than usually 1%, and then you have a 3 or 4% pullback. That's what this again, these momentum indicators show. And by the way, just to go back, if I didn't update it, I mentioned it recently on QQQ in one of the recent videos. The PPO, which is a great trend indicator. Let me put up the PPO histogram on a weekly time frame. This is a weekly chart of QQQ. Forget about all my busy lines up there. That's a busy board. This is the PPO histogram, and you tend to have, what I need to do is park these. Let me get these out of the way for you. Park that, so we can just focus on price, turn off all the lines there, and just show you that typically when the PPO is below the zero line, here's your zero line, the trend is bearish. And when you're above the zero line, especially there's a big hill, the trend is bullish. Doesn't look like much, but that was the biggest correction we had since the NASDAQ took off in the beginning of 2023. And it was marked almost the entire time by the histogram on the weekly chart being below the zero line, meaning that made a bearish PPO crossover. And you don't always get the crossover when it appears imminent, but again, it doesn't take an astute, experienced market technician to look at these lines and say, okay, well, I see, everything every week it's falling, it's going down, and ultimately you're going to cross, right? Now, sometimes it looks like that, and it did here, and then you bounced, right? And it kept the uptrend intact. So right now we're at 0.5 on the weekly chart. So if we close this week or next week, even flat, remember, that's the other thing. The market's not really going down, but the histogram is. And again, that is because momentum is stalling out. It's, you're going up strong, and now you're not going up strong. You're going sideways. And so if you get a bearish PPO crossover, maybe it'll prove to be a whipsaw. But again, you can look at the trends over the years. There's downtrend. That was COVID, and it told you the trend was bearish. And these corrections, even the corrections along the way. And there was a big drop there, and the whole time that PPO was red. So there it is. I just wanted to point that out because I meant to bring that up before. Park that back there, and let's keep it short. I'll wrap up with the VIX because I've been covering the VIX a lot lately. And again, we're in that, today's Tuesday, so we're, the FOMC noise now. This is, where, as I said, It's certainly don't want to read too much into anything that happens the day of. And, it's only especially the press. The announcement's at 2 p.m., but then the press conference starts at 2:30, and that's not done until after 3. So the market's almost closed. So Friday's your first. Thursday's your first full day of trading. That was red. Friday after that is this next trading. We're down again. And now, at least on the S&P 500, down both those days, and down again today. Almost, we're close to being flat. So there's that trend line I had been talking about. We had objective pullbacks to there, and again, I said that the VIX would not, and I still maintain, will not take off and spike up to the higher levels until and unless we break those key levels, including the all-important 443 on QQQ, which has not been violated, not even with a pre or post FOMC whipsaw. So that's what I'm considering this so far. It's below the trend line. And look, that's if anything, that's net bullish for the market because the VIX broken up trend line support. However, it did it on the FOMC day. We back test it. We're below it. But if you turn off all the lines, here's the thing. I don't have a strong opinion on it. We're still above that previous low. We're still coming off a big divergent low. So there's still potential there. Whether it plays out, now to see it recover back above the trend line, obviously that would be bullish. And then that, what I call about $16, I said was very significant resistance. And I think that's going to coincide somewhere in here. Probably now, I think if we move back down to the bottom of the trading range in QQQ that I started the video with, around 433, that's probably going to coincide with the VIX moving up here to around this area, about $16 or so, maybe 17. Then if and when we break below 433, that's when the VIX should explode. Otherwise, if we never do that and the market continues to grind higher, especially, go through there, then the VIX is going to come back down here. But remember, the VIX is at the end of a major support zone. This is in recent years. We're going back to 2018. This is as low as the VIX get. This is a major support zone, and that's why I highlighted here. We hit that support zone. So the thing about the VIX, you can't buy what we're looking at here. This is the spot VIX. Unfortunately, there is nothing that tracks the spot VIX. You can't invest in it. You can't buy it. All you can do is buy derivatives that are based on the VIX, and those are VIX futures, options on those same VIX futures contracts, or ETNs that then roll the VIX futures, and they're just plagued with fees and decay and all that. So, VXX will show you it's a guaranteed way to lose money if you sit and hold, even when the VIX is at the bottom of the trading range, because the bottom of the trading range on any of these VIX ETNs is zero. Because they just over time, due to the expenses, they just go down, 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 down. However, if you get in at the right time, it's a hit and run vehicle. So you have to have, I keep talking about a high probability sell signal on a break of 433 and some of those top sectors in the S&P. Well, you need those to really go aggressive into the VIX as well. Be careful on that. So on that, let's just leave it there, or let's just wrap up because I mentioned the sectors. XLK, top sector, the S&P 500. I started to earlier, told you it was on the, still below that divergent high, bearish engulfing candle, moving sideways, just like NVIDIA, still, NVIDIA still below the bearish engulfing candle, moving sideways, NVIDIA below this yellow trend line. You have maybe a benefit of the doubt secondary trend line. I'm just going to leave that off for now. Second largest sector in the S&P is the healthcare sector. Also has yet to violate my key yellow level for 144.55. Very well-defined support. Lights out, in my opinion, if that goes. XLF, well above the 40.53 yellow level, but put in a bearish engulfing candle recently and a divergent high and remains below that. You can see, and that was actually post-Fed. So post-Fed, it rallied. And then they sold off hard on the on Friday, and put in a bearish engulfing candle, which we're below right now. And then you have XLY below the yellow. I don't have a yellow support level that's that important. It was this yellow trend line breakdown back test. So there's still decent evidence. Certain sectors have broken some of the initial support levels, but we still collectively need to see most of those go. And again, QQQ and SPY, those yellow levels. I keep harping on QQQ 433, but remember on SPY, I have it at about 502.81. We're well above that now. So I think when QQQ goes, SPY will then quickly follow. And I just wanted to say one thing before I wrap up here, or highlight one thing that is, went through the top sectors of the S&P 500 as well, because you have financials in there. So let me do it that way. Let's go to XLF. I'm just seeing a lot of, you can see this is JP Morgan, the king of the financials, biggest one. Bearish engulfing on Friday as well. Bearish engulfing all the way back here on Berkshire Hathaway, which it's still very much, I highlighted at the time, then it broke trend line, still well below that. But this would be that yellow level. I would give it about 400 right there. And anyway, I wanted to point that out, that a lot of these financials just recently I noticed have either broken trend lines or you have like MasterCard, for example. Remember this uptrend line I shared here? And that broke down on Monday below the trend line right there. There's a sell signal on MasterCard and Visa, and these are some of the biggest financials. There was Visa. That was my primary uptrend line, breakdown back test, and we're still below it right there. And a big old red candle on Monday. So there it is, guys. Nothing has changed on my longer term swing trend trading outlook. We had an objective short on Thursday, which still remains profitable. And then that all-in moment, aggressive short moment is still when we get the yellow trend line breaks. Again, on the majority, especially on QQQ. And we'll go from there. And that's it. If you ask, no one, I haven't seen any updates or questions on gold, but this is another one, great example. We sidestepped, we hit T1, T4, we got out. That was a final target. We milked this whole run here, got out, and we sidestepped this mess. Just so you know, I don't have much of an opinion. I see a potential bearish PPO crossover. And when I have a higher degree of confidence, I'll re-engage this sector. Feel free to ask me for updates on it, but I don't have a strong opinion right now on gold, silver, and miners, nor any position at this point in time. All right, I will wrap up here. This has been Randy Finney with Right Side of the Chart. Have a great day.